Finovate showcases cutting-edge banking and financial technology through a global conference series featuring short-form demos and thought leadership. Now, the conversation continues on the Finovate podcast.
Hi, everybody, and welcome to the Finovate podcast. We've got a fun one for you today. Joining me, we have Devon Kirk, partner and co-head at Portage Capital Solutions. Devon, thank you so much for joining me today.
Thanks for having me, Greg.
So I think some people will likely have heard of PCS, but for people who haven't, can you start with just a quick overview of your own background and what PCS is all about?
Sure. So I co-head Portage Capital Solutions, which focuses on growth equity and structured equity investments, specifically into fintech businesses across North America and Europe. And we were established as a platform about a decade ago and have close to 100 portfolio companies today that range from seed stage to scaled profitable businesses. And really, we look to leverage our sector focus to bring specialized expertise, resources, and network to support portfolio companies. In terms of my background, before joining Portage, I led the capital solutions strategy at CPP Investments, and I've been a certified fintech nerd for about 20 years now.
Wow, that's about as long as there's been fintech to be a nerd of. So definitely some good background there. What types of companies would you say are in sort of the sweet spot for Portage in terms of size or focus area, things like that?
Yeah, so we focus through the capital solutions strategy on businesses that are Series C or later that have at least 20 million of top line and a clear path to profitability if they're not there already. We look at companies that are selling technology into financial services providers, as well as companies that are directly providing financial services. So open-minded to balance sheet-oriented businesses, as well as SaaS-oriented business models. And we look across verticals. So insurance, banking, wealth, capital markets, payments, reg tech are all areas that we have invested and have strong theses.
Yeah, and then that really is just about all the big subsections of fintech, certainly in terms of what we're seeing on our stages. I want to get into a little bit of a shift that's happened in the fintech ecosystem over the past several years where there's, I think, a greater emphasis being placed on early stage companies demonstrating profitability much more quickly, or at least a path towards profitability. Whereas in 2016, 2017, 2018, you would see companies getting a lot of funding, maybe on the back of having a really good idea or a really good piece of technology. Now there's a little bit more pressure, I think, on these innovators to not only demonstrate they have a new product or technology, but also that they understand kind of the business side of it, the idea that you can actually run a company. From your perspective, how is this playing out in terms of, is this a good thing? Is this a bad thing? Is this changing the fintech industry in ways that are positive or negative? What are you seeing from your side?
Well, I think there's no doubt that having a higher cost of capital, as we've seen over the last couple of years, means a higher bar for investments, and particularly for investments that may not pay back for some time or at all. And that can mean less innovation, but it typically is the least promising opportunities that are getting killed. And I think the increased discipline can yield real benefits as well. I almost think about this dynamic as kind of cutting off the tails. So you may have kind of fewer outsized home runs, but also have fewer failures. And as management teams focus their resources on the most promising opportunities, that can actually lead to more successful outcomes. At the end of the day, I think it's about not so much about growth versus profitability, but really about the quality of growth and quality of profits. If a company is growing quickly at really attractive unit economics and is unprofitable because it's investing in things that are going to enhance its unit economics or strengthen its moat, that's completely different than a company that's growing quickly because it's overpaying for leads and burning because the unit economics on those leads just don't work. So I think the market has gotten much more discerning in how they think about different financial profiles and the underlying drivers.
Yeah, I would tend to agree with that. And I think we're seeing this on our stages as well, that the companies who are getting up, who have raised a Series A or a Series B, tend to be able to better articulate not just the technology that they're demonstrating, but also the use case for it, the business side of things. So we're seeing that maturity. And I think, from my standpoint, we were probably in a situation that was really unsustainable just prior to 2020. The amount of money that was being thrown around in the ecosystem was just crazy in a lot of ways. But I have heard from people who kind of made it to that unicorn status, prior to the pandemic, who have said, I don't think I could do it now. I don't think I would be able to build the company that I built without having the kind of funding that I had. And so I think this is where there is this kind of double-edged sword to it. On the one hand, it's certainly realistic to expect companies to live within their means, and obviously profitability is key. But on the other hand, some of these moats that you're talking about can be very substantial and very expensive to build. How does Portage look at that type of thing? How do you kind of make this call where you look at a company and say, okay, I feel like this is, reasonable expense because I see you're building up a really sturdy defense that will then enable you to go out and become a world beater? How do you kind of identify that and make sure that you're not cutting those types of companies off from funding that they need?
Yeah, so a lot of it does come down to understanding unit economics, but also really supporting our portfolio companies in being strategic around where they make their investments. So we're seeing a lot more thoughtfulness around how you leverage partners to go to market more efficiently. That's really important when you're selling into large FIs that are increasingly focused on consolidating their technology providers. Leveraging partnerships can be a really important lever, particularly in the early years. They're also being more focused about which customer profiles are attractive or not. So instead of just sort of adding any customer that comes to the door, really, really understanding their ICP and being targeted about that. Also really focusing on building product that they can readily cross-sell to existing customers versus just focusing on adding products that will allow them to attract new customers. And that's obviously much more efficient from a customer acquisition perspective. So, I think all of that, as you say, is really helpful for sustainability of business models and can also be really good for founders. One of the things that we don't necessarily talk about is, this model of raising massive amounts of capital and thinking that that's the only way to become a unicorn can be really dilutive for founders. And we've certainly seen that over the last few years where a lot of founders have, seen in this, environment where valuations have adjusted that they wish they didn't have so much kind of preferred equity sitting above them.
Yeah, I think that's a really difficult one for founders to try and understand is, how much capital should I take on? How much do I really need here? And I think anything that you take in early, obviously, you need to account for when you are going to be making your exit later on. I want to just ask one question, which is a little bit nebulous, but in terms of the actual quality of fintech, someone who's seen the industry for 20 years, as you said, do you feel like the companies that you're seeing now who are kind of at this Series C stage, are they better? That's a difficult word to really define, but do you think the quality of the companies, the quality of the technologies is getting better as a result of this? Or is it really, similar types of innovations, and it's just a different way that we have of kind of elevating certain ones into this role of the potential ones who could be game changers?
So I think on the negative side, growth has certainly come down over the last few years as companies have pulled in their spend. And so we do see companies that are growing at slower rates than, we used to see for Series C businesses, but certainly more sustainable business models. And I think, AI is really playing an interesting role in allowing companies to accelerate their pace of innovation, and their development costs going down. And we see that as a really interesting lever to drive not so much AI specific businesses, but higher quality businesses in general, as companies have more opportunity to experiment with different products. The other thing that I would say we're seeing is that because many companies deferred raising capital for a couple of years when they didn't like where valuations were, that many of the companies kind of raising Series C or D are a little more mature than they would have been a few years ago. They kind of pushed out their runway and are kind of later coming to market than you would have seen.
Sure, and I think that makes sense. That's a pretty reasonable response to the circumstances that they would have seen. I want to switch gears now and talk about exits specifically, about IPOs, M&A activity. At a high level, what are you seeing from your perspective right now in terms of what type of activity do you expect to see in 2025 compared to what we would have seen last year or the year before?
So we're certainly hoping to see a few fintech IPOs this year. I think that is likely to happen, and less clear how those will perform. But assuming all goes well, that will hopefully create some momentum for even more IPO activity, heading into 2026. I think from an M&A activity perspective, you'll also see an acceleration in activity there. But it'll be primarily kind of mergers as opposed to kind of cash out transactions. I think there's still a lot of noise in the market from the sort of whipsaw in valuations that may make kind of equity-based deals easier to get across the line. And so I think all of that means that you'll see more transaction activity, but still, I think a lag on venture investors and ultimately their LPs getting kind of real capital back. Even post IPO, it'll take time for folks to sell down, and as I mentioned, I think those mergers will help to position companies for a broader liquidity event, but not necessarily drive a lot of liquidity initially.
Sure. Yeah. So a little bit more patience required. When do you think might be a realistic time frame to really see that activity kind of pick back up? I mean, we're talking now about a lot of companies who are, as you said, more mature, ready to kind of come in and take funding in a way that's a little bit more responsible, maybe do a little bit more with it. And I think that groundswell looks like it's going to crest at some point. What do you think might be a realistic time frame for when we'll start to really see the fruition of all of that coming and start to see some really intense activity in that space?
So I think the IPO market right now is being mostly held back by investor dissatisfaction with the discounts and ultimately the valuation that they can IPO at. I think if you see some IPOs performing well post IPO, that'll help to reduce the discounts and make an IPO more attractive for existing investors versus the dilution implied in the current market environment. And so I think if the public markets are receptive to those IPOs and overall markets are stable enough to support those companies, then I think that will be a real source of support for the sector more broadly and help to drive liquidity and ultimately investor confidence in investing at the later stage.
Yeah, it's going to be kind of the age-old fintech thing where everybody's going to be lining up to go second. Nobody's going to want to be the first one to test those waters. Although who knows, there might be a big advantage to being somebody who's ready to kind of jump back in. We will have to see. What advice do you have for the founders in your portfolio companies as they start to think about what their exits could look like, or maybe even earlier than that? Some of our listeners are coming from very early stage companies, so I'll broaden the question and say, what advice do you have for innovators in general who are trying to figure out what their exits could look like and how they can build a company that's going to end up getting them where they want to go?
So I would say one of the things I see is that founders tend to be really excited about the idea of an IPO. And I think one of the lessons learned from the last few years is that subscale IPOs are not a good outcome. Companies that either IPO directly or de-SPACed over the last number of years at relatively small market caps have really struggled in the public markets, and it can put you in quite a difficult position then. And so I think what we're seeing is that the bar has risen to IPO, and that's probably going to be a relatively long-term dynamic, that if your expected market cap is less than $1 billion, you should be thinking pretty long and hard about whether an IPO is the right step for you. And I think that means that founders need to be more strategic around how they position their business for a range of different liquidity events. So understanding, which strategics might be interested in your business and why is something you should have in mind when you're developing your product roadmap, for example. Understanding, the long-term cash flow profile of your business and whether that's going to be attractive for sponsors, and what other value levers they might look for, whether it's M&A or otherwise, can also be important. So really starting to think proactively around that. You can never, have certainty on what your path to liquidity is, but maximizing optionality, I think, is going to be increasingly important. And I think sometimes founders struggle with that kind of medium-term planning. Many are, fantastic at having a big, bold, long-term vision, and at, really executing hard to drive kind of near-term results. But having that kind of 3, 4, 5-year plan around how to position the business sometimes gets a little lost in the mix.
Sure. Yeah. I think that's really good advice for anybody, no matter what stage you're at in the innovation cycle. And certainly this is good food for thought for us as we come into the year of great fintech demos that we'll see on stage at Finovate. A lot of different stages of companies. This will give me something fun to talk about backstage with all of them. I want to end on a kind of fun one. When you look at fintech, not through the lens of an investor or somebody who's been inside the space for so long professionally, but if you look at it through the lens of a consumer, what interests you the most? What are you most excited by when you think about what fintech is doing now, what it could be doing? What are you excited to play with as a consumer?
So I sit in Toronto, and Canada has not yet adopted open banking. And I see open banking as having huge potential to enable competition and improve customer opportunities, particularly around the SMB lending space, which incumbent banks have struggled to serve well. I think we're at a moment in time in Canada and in other economies as well, where there's much more of a impetus for how do we continue to drive growth? How do we support innovation? And I'm hopeful that we are at a point in time where there's going to be increased focus on some of those structural enablers.
Yeah, and certainly this is one of the things we're gearing up now for Finovate Europe, which is coming up in London, and some things are possible on that side of the pond that simply just aren't realistic here in North America. Because they implemented the open banking regulations. They made it a requirement. And while there was some initial grumbling about that, I think everybody's sort of seen now what the flip side of that looks like and what you can do now with a lot of that. So there's a lot of positive things that will come out of that. I'm with you. I'd love to see that become more of a reality as well. I'm afraid that's it for our time today. But Devon, I want to thank you so much for taking the time to connect with me and share your thoughts with us. It's been a great conversation.
Thanks, Greg. Great speaking with you.
The Finovate podcast is produced by Informa Connect in association with Provoke.fm Media. Check out Finovate.com for information on Finovate's upcoming shows and to learn how you can get involved. The discount code Finovate Podcast will save you 20% on tickets to all of our events. And you can email us at info@finovate.com for information on sponsoring, speaking, or demoing. Thanks for listening.